God, indivisible, liberty and justice.
So let's do our roll call.
I sure hope that was on YouTube.
Okay. And who's that? I don't think we've met her before.
That's Amanda.
It
That's
is Amanda.
Hi, Amanda. Okay,
I know,
so
this is like
Jim
the
Jasper is
closest in
here.
person we've ever done.
Nice to see
Jim
everybody.
Jasper is here. Ross Sharkatz is here. Paul Shea is with me here in my office in Cheshire. I've heard David Bowery. I think both Steve and Kevin are here
Hello.
from the police.
Hello.
Hello.
Hello there.
Hello.
She's going to be dutifully taking our notes. Thank you.
Yes, I'm taking notes.
Okay, and then do we have is Mark Izzo on the line?
I don't see Mark.
Okay. What about, is Jeremy on the line?
No, I wasn't. I'm going to admit Mark now.
Okay. We get to a quorum.
Jeremy, I don't think could make it tonight.
And is Dennis back from Florida?
Supposed to be.
Hello. Oh, little West Coast, little Golden Gate Bridge I just saw flash across for a second.
That it is. That it is.
There it is. Very impressive. Okay, so this is obviously something a little different. Is there a representative from the firefighters here that I missed?
Mr. Shaligan is not going to be participating. He may be able to join us a little bit later.
Okay, and so that's no Dennis and no Jeremy.
Yeah, I think those are the only two that are missing.
Okay, so does everyone have the agenda in front of them? We will start with the approval of minutes. Has everyone had a chance to review her excellent minutes
Excellent.
from February 6th, back when Trump was getting acquitted for impeachment?
That was a long time.
Exonerated.
It was a lifetime ago.
Lifetime ago, that's for sure. Does anyone have any additions, any modifications? They're very well done. Thank you, as they always are.
Yep. So
Wanna
Mike,
make a
I'll
motion?
move that we accept the minutes
Okay,
presented.
Mark, can I have a second?
I'll second the motion.
That was Paul Shea. All in favor? Aye.
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 Okay, so that's that. I don't think we have old business tonight. So do you want to get right to the investment update and we'll do officers at the end, Jim, or what do you want to do? I know we have Claire Bush coming on.
Yeah, I think we could start right in on the investments.
Okay,
So,
all right. And then is Clarebridge coming on at 6:30?
Yes.
Yes.
Okay. Okay, so Ross, Amanda, it's all yours.
Okay.
So, Ross, if you want me to put the document up on the screen, I can do that.
That would be great. I would love that. And either I can flip it or you can flip it as you go, however you like.
Bear with me.
That's my favorite. Yeah.
That's your ceiling, by the way. Put that in.
Wow, that's what we're looking at. That becomes the default, right?
I guess. Amazing. Do what they are.
I don't know. Let me see if I push it back if that does anything.
No, it's okay as long as we can hear. It's your cell phone. It's a camera on your cell phone. It's protected.
Is that what it is?
Yeah, you see it's on. I come up over here. Oh,
On mute, I get.
Oh, there's Mr.
Bear with me
Flag.
a few minutes.
Hi, Dennis.
All right, sorry, guys, I had no volume. Thank you.
Okay,
I've been listening.
We'll add Dennis Flag. Welcome, Dennis. Nice to see you back from Florida.
Thank you, Brennan. Thank you.
Sorry, desktop. That might work. There we go. Okay, now you got.
There's coming up.
Good job. And that, yep. There you go.
That's almost.
And you don't have
I
to.
had that before. And I thought there was something wrong. That's why.
Yeah.
Okay.
Ross, can you see this?
Sorry. Just click
Yeah,
on
I
it.
see your, absolutely. I see your files. I don't see the PDF. I think you may need to open it.
Yeah, just click on that. That's to do it.
Can you see the document on the screen?
No, I see your, we all see your file screen right now.
Yeah, we just see the
Do
file.
you have multiple screens possibly?
Okay. All right, we're gonna get it. Yeah,
Go.
yeah, you need the, yeah, red X. Close that. Close,
I didn't print the
up
whole thing.
to your
Watch
stuff,
the
right?
page. Important pages. I'm gonna do.
Oh,
Okay.
okay.
That's my
And what's that?
half of them pretty devastating.
What's that?
Well, that's more
Open
than
that.
half, are pretty devastating to the plan.
Okay, now, shit, what is it, oops, sorry.
Okay.
All right, see if you can get the X again.
Doesn't it seem like a rectangle? That's maybe. Crazy.
Yeah, let's just change this, so,
Well, a lot of
you following Michael's one thing?
it's awful, isn't it?
Right click that.
But you know why he confessed? Because they were threatened to send him to jail. That's why he confessed.
Yeah, but now we're not even getting live. They just.
It was ridiculous.
They
Tell them.
extorted, yeah, they extorted.
Yeah, it was awful.
It is.
Oh, it's awful. Same guys too.
Okay.
Truck should be in jail for the next 10 years.
Here's a bunch of-
Tony. On cars.
Oh.
I actually.
We did it. We have the
Ah, there
technology.
we go.
Hey, Jim. Hey, Jim, hit Control L. I'll
Yeah.
give you a little clue. Hit Control L.
Okay.
Oh, so
It'll
you
get,
can
it'll,
you
do a-
select, all right, you're gonna give him control over it.
no, I'm not taking control. It'll just
Oh,
that
you're
way.
not? Oh,
No. Well, he can if he does, if he wants to, I can do it. But if he hits Control
that
L, it'll look like it'll work as a slideshow, and we won't see all it'll fill people's screens.
I'll be like full screen.
Yeah.
All right.
You don't wanna see each other?
I think I did hit.
No, we'll still see everyone. It'll be cleaner.
Face
Either way.
made for Zoom.
Or try clicking the, no, the left of the X, yeah.
Right
Yeah, no. All right,
Yeah, I had tried Control L, Ross.
Okay, we'll just go this way. That's all right. I can for sure. So why don't we do this? We have Amanda. They're coming in like about 15 minutes.
Yes, at 6:30.
So well, there's a lot more than 15 minutes in here, but so I'll get through what I can to get everybody up to speed. We'll have them on, and we can go however you like. But why don't we do this? Why don't we? The information here is through March. We may as well look at the ugly information because things have improved a little bit from here. But Jim, if you just turn the page, I would just flip 2 pages in, page number 3. I'll just give everybody a rundown as to what is, what's taking place in markets here, just at a very high level. So does that sound okay?
Yeah.
Fine.
So on this page, you'll see the notwithstanding the reasons, the market sell-off that started in late February, around actually February 19th, if you want to be precise, and the decline is the fastest decline. Usually, you think of a bear market as being a 20% decline. The fastest decline ever in market history, you can see is the red line. The blue area, the blue line is the average of all prior market declines that eventually reached 20%. That's the 100 going down to 80, and the range are those different shaded areas. And so the lowest area in that shade is the last worst time at the bottom of that, and you can see in terms of how many days. So in a matter of weeks, we saw what happened. We saw markets go down by. We saw markets go down by more than 20% in a matter of a few weeks. Things that normally take a number of months, and of course you can see a little bit of a rebound there going into the end of March. Next page, Jim. And just to give you a sense as to how volatile markets are or were, this is the VIX index, and it basically is a measure of volatility, and it goes back to 2000, and you can see the 2000, NASDAQ bubble blowing up back then. You can see in the middle part here, the 2007, 2008, 2009 bear market, and you can see all the way on the right-hand side what's taken place, very recently. And you can see not only did it reach and actually eclipse the level of volatility that took place in 2008, but you can see, 2008 was, 2008. It was 2007 to 2009. It was, 2.5, almost 3 years. This is all a matter of weeks that we've seen. So the next page, Jim. It's not. It's not just in stocks. It's been everywhere. It's other than in U.S. Treasuries. I mean, you can just look at something as simple as investment grade fixed income, and you can see here on the left-hand side that investment grade bonds, excluding Treasuries, you can see went straight down. You can see all of 2019, and you can see the decline. All that took place in March. And on the right-hand side, you can see spreads. In other words, this is the interest rate in basis points. Every 100 basis points is 1%, that one would earn at any given point for owning investment grade bonds above Treasuries. So if Treasuries were yielding 1, investment grade was yielding 2.02, is that 102 basis points. And you can see, because the prices declined so sharply and so quickly, spreads really blew out up to levels, that you saw at the beginning of the financial crisis. Next, Jim. And just in terms of the number of volatile moves, just day by day, all we're showing here is the number of, you think of the distribution on a statistical distribution. This is the number of 3 standard deviation moves in asset classes, whether it's S&P 500 as U.S. stocks, emerging markets equities, Japanese equities, currencies, commodities, etc. The number of the extent to which asset classes were volatile by a degree that one of these sort of once every few year type moves, the number of of those moments exceeded in the first 3 months, and really it was almost all in March, what took place in all of 2008. Next, Jim.
Only 19 times.
Just to give you a rundown, and I'm going to go through 2 pages here just to talk about stocks and then bonds. There's an sort of a theme, an interesting theme worth paying attention to. The S&P, as bad as it was actually held up better than just about any other area of the stock market. And what you'll see here is if you look at the S&P, and keep in mind one thing, or this would have been a punchline, but that you have 9 stocks make up about 25% of the S&P 500, because the S&P 500, it may be 500 stocks, but Facebook and Amazon and Apple, et cetera, the largest ones comprise, are the largest portion of the S&P 500. So what you'll see here is you'll see in U.S. large cap stocks in the month of March, large cap growth stocks went down by 10% and were down 14.5% year to date. The S&P was down 12.5% in March. The S&P value stocks were down 15% in March. And then if you just took the S&P 500, equal weighted it, said, what is the average, return or, for stocks, it was down about 18. So if you look, let's just use the year to date, which is the first 3 months, the average stock, the equal weight of the S&P 500 was down about 27%, whereas the S&P was down 19.6. So you can kind of get the effect of how much growth helped and how much a handful of the biggest companies, if you only own a few stocks, and of course, a diversified portfolio doesn't. And you can kind of see the same thing if you go from large into mid, which is the S&P 400. So mid-cap growth stocks outperformed mid-cap value stocks by a significant margin. Small cap growth stocks outperformed small cap value. And then, of course, large outperformed mid, which outperformed small. So you kind of can see a theme. And then when you get outside the US, I didn't really break it up here, although the same thing is true. Growth outperformed value around the globe, including the US. And the US outperformed outside the globe. And then you can see commodities in other areas just as a frame of reference. I won't focus on that. Jim, on the next page. This is, I think, really where all the action ultimately was. Stocks go down, and, it happens for whatever the reason. But across in the fixed income markets, it was you can really see how messy things were. A couple things that are interesting. One is you can see how indexes in the bond world, more so really than in the stock world, are they're very good guides, but you can't actually buy an index. I mean, there are index funds, but indexes are, this is when you realize how theoretical they are. You can see, for example, in the Barclays government credit 1 to 3 year, very short term fixed income, high grade, not investments that you worry about defaulting. Year to date, or even let's just use March, for example, where it was up 1.3%. So it kind of makes sense in a really bad environment. People kind of race for cash. But if you look at what actually happened in short-term bond in funds, they were down by 2.6%. The same thing is in the real mid area here. You can see that treasuries, the treasury index, 7 to 10 year treasuries, was up 3.5%. The Barclays aggregate index, which is almost half treasuries, was up 1.3. Municipal bonds, and actually, if I had run this 3 days before the end of the month, it would have been double-digit declines. But municipal bonds were down 3.6%, and you can see that bond managers, on average, again trafficking in the same securities, were down 4%. And then you can see below investment grade and high yield. And so what you see here is that the reality in the markets, because for reasons I'm glad to get into, the reality in the markets was much worse than even what the headlines might suggest from an index level. And again, outside the US was worse than inside the US, kind of as you go along. Next page, Jim. I'll skip this page just in time. I'll skip this one too. It's an important page. We can use this to reference. We'll come back. I think we could probably keep going. Just in terms of our views, and I'll use these 2 pages, and then we'll just kind of flip over into the portfolio update. But our views coming in, and this is no different than you've heard these from us before. So I just consolidated into a few bullet points. Our views were that that looking forward, that returns would be more muted than historic returns. Kind of going back over a long period of time. Bonds would not, at low interest rates, would have difficulty helping diversify portfolios like they have in the past. That we would at some point see a pickup in volatility, particularly given the fact that we felt that markets were sort of late in the cycle, and economies were late in the cycle. And then looking forward, that we prefer international, generally speaking, over U.S. Emerging markets are, being undervalued, and then value versus growth. And the key sort of thing here in value versus growth, and somewhat related to the first 3 points, but we don't know quite when, and we don't know exactly why. But one of the key things about something like growth is outperformed, but typically what ends up happening, where these things begin to turn, they don't just sort of as they say, bull markets don't die of old age. Typically the shifts occur in a recession, and so if there is going to be a growth versus value shift, usually it's in a recession. You can go back, and I can even show you maybe 2 pages forward. I think it's 2 pages forward here, Jim, page number 13. Then I would go back. Sorry, you can go that right there. You could, again, you can. This is a visual. This is basically the equal weight divided by the S&P, but you get a similar type of a visual. You can see the gray area is recessions, and so very around recessions is when these types of things, the growth versus value historically will turn. And of course, we haven't had a recession in a very long time, and that very well may speak to some degree as to what's taken place. We have about three minutes, so and I don't know if we want to nudge them back at all, Amanda, or we want to have them come in, and then Jim, we can come back. I don't want to. I could. My time is yours, although I want to also be respectful of all of your time.
We're still waiting from our end, from ClearBridge's end, Corey. Jake Drosner will be giving the product update. So
okay.
I'm here for you whenever you're ready and Jake arrives.
Great.
I think Jake's in.
Yep, I'm here.
So why don't we do this, Jim? Why don't we? This will be the Jim. There's 2 Jims. So this is Jim Jascott. Do you think it's okay if maybe we have our since they're on our friends at ClearBridge, maybe have, I don't know, maybe spend 15 minutes or so. It can be a relatively short presentation, but we have the materials here,
Sure.
And I think the goal is really just to we did invest. We sort of went backward. Usually, we would ask someone to introduce themselves before we invest, but we sort of took care of that for you all. But have you guys introduce ClearBridge and maybe familiarize everyone a little bit more than they are now, to introduce at a high level.
Yeah, absolutely.
Ross, the materials, are they in this package or are they in a separate package?
Jim, they are. They're at the end.
Okay.
Yeah, I think if you go to page 60. Oh no, there you go. Sorry.
What page is it on? What page?
You're on it now.
Yeah, you're in there now.
And I have it at home. That's why I'm asking. What page are you on?
53.
Thank you.
I don't think of that. I like to highlight.
Is that where we want to start?
Yeah, go. If you're ready for us, thanks for having us on. This is Jim Bassler. I'm a representative for ClearBridge that works with Ross and Amanda, and we really first I wanted to state that we're greatly appreciative of you taking a step and investing with our firm. I know it's only been a few months now, but obviously a pretty trying period of time that hopefully we can shed some light on you for. With Jake Drosner, who's our product specialist on the line, who works directly with our portfolio management team. You'll see that in the deck we've got a long history of managing money from a fundamental research-based process at ClearBridge, and the team that you're invested with, Peter Bourbeau and Mark Vetrano, who you'll see on the screen there, are some of the finest investment managers that I represent as a client-facing salesperson. So I'm going to turn it over to Jake and take best advantage of that 10 to 15 minutes that we have with him, getting you an update on firm and how we've kind of navigated these markets.
Sure, and thanks, Jim, and thank you everyone for having me on the line today. So I'll just start off with a very brief commentary on how we got here, and then a little bit on our outlook and performance, and then hopefully leave room for questions at the end. So we've been more active in the last couple of months than probably the last few years. That's because heading into the downturn, something we were uncomfortable with was valuations, generally speaking. We thought they were pretty stretched across the board, especially in our risk management efforts. So we had built up a lot of excess in the system and essentially blew it apart in just 30 days. We think that COVID was just the catalyst for that, and the virus was more the match than the kindling for this recession. So we saw systematic issues like stresses in dollar funding. We then saw spreads blow out, and eventually, of course, it trickled down to equities. And we think the speed of the decline was so dramatic because of these problems in the dollar swap market and also factor. But the good news is that a lot of that forced selling pressure that we saw in March and the massive liquidation due to leveraging, that's effectively over. So we saw the damage in just 18 to 20 trading days, and now it's on us to understand the magnitude of the recession and also to understand the response by the Fed. So we think this is going to be an opportunity for us when the system gets cleansed of businesses. So weak business models that have poor operations using cheap credit, those aren't going to make it to the other side. But from our perspective, it's just too late to get negative. So we've been very aggressive in repositioning the portfolio for the other side of this to benefit from the recovery. So we're upgrading to quality assets where we can gain some clarity on what the balance sheet and what the income statement will look like. So I mentioned our job from here is to understand the magnitude of the recession, and we're going about that by separating deferred versus destroyed demand. We're going through all of our existing holdings and certainly our whiteboard of new ideas, and we're stress testing all of these companies, and we're using a scenario where we actually go ahead and assume 50% reduction in operating income, and that's again to stress test every business in which we invest. We're also analyzing if companies could have liquidity issues, what percentage of their costs are fixed, what percentage are variable. And we're also looking at what lines of credit they have available. And then what we're avoiding is weak business models that have been propped up by the low cost of capital and financial distress situations that have historically been caused by leverage. That's a little bit about our outlook on the markets. I'll head into the way we performed. During the first quarter, I tend to break it up into three categories because the first part of the sell-off was relatively non-discriminatory selling pressure. So everything was down the same amount. And our more defensive positions, stable growth companies like Comcast and United Health, they didn't hold up as well as we would have expected. But then from early March to the 23rd, which was the worst of the selling, we outperformed by about 200 basis points. And that's because it was driven by a rebound in more defensive areas as the sell-off accelerated. We also had some beneficiaries of at-home dynamics, companies like Akamai and Amazon that benefited from stay-at-home policies. And then most importantly, the reason we outperformed during the worst of selling and protected capital nicely is because we were very active in trimming our exposure to second derivative energy companies and also to interest rates ahead of the downdraft. And then we lost ground from March 23rd through the end of the quarter because it was a very momentum-based high beta counter trend rally. We lost over 150 basis points in just those 7 days. So net on the quarter, we trailed the index by a little over 30 basis points. Communication services was our largest detractor from a sector perspective. We had companies like Disney that suffered from the harsh reality that their parks would be closed. And parks makes up 40% of their earnings base. And our evaluation of Disney has been that there's downside from here if their parks don't reopen in June, and certainly downside if there's a behavioral change. People don't feel safe going back to parks after they're reopened. So we've reduced our position size meaningfully. And then we have also some holdings in financials that detracted from relative results during the quarter. But again, companies like Charles Schwab, we trim those positions in order to reduce our exposure to interest rate sensitivity. Another name that we sold at the very beginning of the quarter within financials that benefited relative results was BlackRock. So we've sold BlackRock in January because our view is that BlackRock's a levered play on markets. So we bought the company in 2008 when it was a one-of-one asset manager that had two self-help levers. They had improving flows and they also had margin expansion. But with those self-help levers gone and likely downward markets from here, we didn't feel that the risk-adjusted returns produced by a lever play on markets would be good for clients. So we entered that position in January, and that goes back to what I mentioned at the beginning of the call, being uncomfortable with valuations across the board. On the positive side of things, our discretionary holdings performed well. I mentioned Amazon did well, benefiting from stay-at-home policy. We have a similar e-commerce player outside of the U.S., Alibaba. And then a name that within tech, which is a pretty topical sector, we had Akamai that did well, and a lot of our secular stories like NVIDIA within PC gaming, those had strong results. But I want to talk about tech in a little bit more depth because you'll probably notice that our largest active underweights are in companies like Microsoft and Apple. And I think that's related to our overall positioning within tech. So we've chosen to focus more of our active positions in those with stronger earnings and revenue growth profiles, or those in the case if we're trying to play defense, those with cheaper valuations. So if you look at Apple and Microsoft, a lot of the price appreciation, it's been due to multiple expansion, not earnings growth. So on weakness, we did add marginally to our Apple position during the first quarter, and we continue to like Microsoft from an absolute position size standpoint. The company we've owned for over 20 years. We think it could continue to grow 12 to 15%. But at this point, the multiple on earnings you're paying all the way out 18 months through 2021 is at a premium to the rest of the market. So we're comfortable with our underweight relative to the index. So I'll take.
Jake, is there a slide I could put on that speaks to what you're discussing right now? Or?
Yeah, I think that slide a few ago of those three bubbles there, I think that's the best slide we have in the deck. And that's because it shows how, sorry, if you go back to 18. Yeah, that's perfect.
Oh, right there?
Yeah, right there.
Okay.
This is a fantastic slide because it exemplifies two things, not only our portfolio construction, but also risk management. So that cyclical category, I like to call it opportunistic. That's going to be about 10 to 15% of the portfolio. So that's not only companies that are economically cyclical, like a TI or a Grainger that's on the slide there. It's also companies that have stubbed their toe for a EPS fixable with a catalyst for that change in the but the bulk of the portfolio is going to be in that stable category. That's 50 to 60%. And those are companies with very low risk of disintermediation that are the top one or two player in their respective industries. So if you look at a company like United Health Group, they have over $200 billion in revenue, and their entire business model is being part of the solution within healthcare. And we think that managed care companies, now that the risk transformative medical reform is off the table with a Biden versus Trump election, are the type of cash flow generative business models that we're looking to own in that stable category. Similarly, Comcast generates $13 billion of free cash flow every single year and has an extremely sticky and growing broadband business, of which demand has gone up significantly with people connecting remotely to work and staying at home. And then most importantly, that select category, we limit that to a third of the portfolio. So that's where risk management comes in. So I'll get back to my comment at the beginning of the call, which is we were uncomfortable with valuations within that select category of growers. And the idea there is that if we have a budget within select, we'd rather spend our overweights on Amazon and Facebook than Microsoft and Apple at this point. And the reason for that is because they have better earnings growth, whereas Microsoft and Apple are really only benefiting more so from multiple expansion. So if you look at Amazon, their e-commerce business is extremely sticky. Their Prime membership is recurring revenue, and they continue to gain scale through their through leveraging their razor thin margins. But also at Amazon, they have their AWS cloud business. That's only 13.5% of their revenue base, but margins in that business are 30%. So from a profitability perspective, love their cloud business with AWS. And then longer term, when ad spend starts to stabilize through the recovery, Amazon's essentially implementing Google's playbook and starting to advertise within searches on Amazon.com. We think over the next 3 to 5 years, that could have 20% upside to earnings. So that's the type of profile where we take an active overweight. Amazon's over 8% of the portfolio because if we have conviction, we have to own more than the benchmark does. But in the case of Apple, where earnings actually went down by 10%, they're even contracted by 10% last year, and the stock was up over 90%. That's the type of multiple expansion that we've shied away from our risk mitigation efforts. I don't know. I know I only had 10 to 15 minutes, but I want to answer any other questions that you might have, or I'll touch on new companies in the portfolio that we initiated during the first quarter.
Jake, it's Ross. I think it'd be good, in the interest of time, maybe if we just have a, see if there's any questions from folks. We definitely, this is very helpful, and we did spend some time, back when with everyone, kind of digging in. So that the group does have some background. So maybe we'll see if there's any questions that you can address.
Well, this is Mike Evans. Well, we know where we've been. So what's your, short to medium term outlook, as we go through the reopening of the U.S. economy and the world economy, as we have all the stimulus money out there? So what do you folks see as we round out? We have an election, obviously. There's a lot of noise right now.
Yeah, so you hit the nail on the head. We have both monetary and fiscal policy that's extremely accommodative. So Congress is spending trillions of dollars in stimulus, and we have the Fed essentially buying everything except for equities at this point. But the question is that enough to offset the impact of stay-at-home and social distancing policies? And I think the real questions are, how can you invest in companies that can actually accelerate revenue growth through the recovery, and that in the meantime are less dependent on pricing to drive earnings growth from here? So where we're placing new dollars or incremental money is in companies that not only can weather this storm and behave defensively, but can also be share takers in this environment and again accelerate through the recovery. So we've been very active. We believe in counter trend rallies. We think that the market has gotten a little bit ahead of itself in the last few weeks, and that bottoming is usually a process, but we're waiting for a retest, not necessarily of the ultimate lows that we saw in March, but a retest of some kind where we can put some new dollars to work. We have a very extensive, robust wish list of names that we'd like to initiate on the second drawdown. And the idea is that we can upgrade the portfolio. We're in a position to buy companies at some of the best risk reward opportunities we've seen in years. And that, I think we exemplified this approach during the first quarter. So not only did we initiate a handful of new names, we also took the opportunity to upgrade from other names. So we're transitioning more to the defensive side of things, because the key is to not sacrifice our down capture from here while getting the portfolio to have a position to have an up capture over one when this does eventually turn. So we've been adding to existing positions. We started to close our under Apple a little bit. We took advantage of the volatility to do that. We've also added to the secular stories in the portfolio, the NVIDIAs of the portfolio, and also companies in that stable category like Comcast and FIS are good examples, highly cash flow generative recurring revenue bases. And then again, the names that we're paring back on are those that have leverage, so a company like Anheuser-Busch, and those that we think are have been behaving a little bit less defensively. So since the end of the quarter, we exited our position in Pioneer, which was our sole energy position, because the fact of the matter is we just don't have visibility on when the recovery will take place in energy. So from a risk reward perspective, we can find better opportunities elsewhere that will behave more defensively in the meantime. Are there any other questions, or would it be helpful if I went through some more trades?
Yeah, talk about a couple more trades. I mean, I see you have 46 positions at the end of the first quarter. Is that kind of your target, that 40 to 50? Or are you looking, you said you have a lot of names you like, are you looking to increase that a little or decrease it a little, or is that sort of your sweet spot?
So right now, in terms of initiating new positions, it's a question of valuation sensitivity and source of funds. We keep cash very low in the portfolio because you're hiring us to own equities. And so a lot of the time we have to fund new ideas by exiting others. And this was a theme during the first quarter. We did upgrades and growth, and a lot of those were one-for-one trades. So for example, we sold J&J on relative strength. That's a name that behaved extremely defensively. And we transitioned from defense to offense within healthcare by buying Amgen. And I mentioned some commentary earlier on our outlook for managed care companies. But in addition to it, Amgen, we got an extremely attractive entry point. It was trading at 10 times its base business. And that's a business that has a 5% organic growth rate. And they also have a pharma and biosimilar business in a pipeline in oncology. So we think that managed care is a great business in the meantime. And because it had gotten so cheap, we were able to transition to offense at a very good price. And it also has a floor on it because of how poorly it performed during the first quarter. We also, another upgrade that we did that was a one-for-one because we needed a source of funds, bought Monster Beverage, and we sold McCormick to make way for that name in Staples. And the idea with Monster is they have an extremely capital light business model. They have that by outsourcing all of their manufacturing, and they're actually minority owned by Coke, which gives them a very attractive global distribution platform. So by not manufacturing and not distributing, they're essentially creating a very strong net cash position on their balance sheet. So when we look for that upgrade coming from McCormick, Monster has better growth, a stronger balance sheet, and also better liquidity than McCormick, which we sold for the same value. I'll go through just one more upgrade because I think it helps explain the process we're doing to make room for new opportunities during the market volatility. We sold Linde, which is an industrial gas player, and that's because industrial gases have more GDP volatility than aerospace. And we bought UTX, which is now RTX. It is a pure aerospace business now that they spun out underperforming assets, and they will be the absolute juggernaut within aerospace, selling to Airbus, Boeing, etc. And they'll also have a very strong position in defense because they have the Department of Defense's hypersonic programs and advanced weaponry systems. And the new fiscal budget has essentially allocated billions of dollars to now RTX's program. They merged with Raytheon within defense. So across staples, across healthcare, across industrials, we're able to take advantage of the volatility to upgrade and growth.
So I think also short answer is you're probably in a range of holdings that you'd see typical for our portfolio as well.
Any other questions, guys?
No.
Well done.
Great. Thank you so much for having me. Have a good night, everyone.
Thanks,
Thanks,
guys. Really
appreciate
appreciate it. Thanks, Jim.
Thank you.
Thanks again for your investment.
Okay, great.
Russ, that was really impressive. Those guys are
Yeah.
Yeah, I would say that one of the themes that we saw in in speaking with managers, and it's all obviously a bit different, is that when markets do what they did here, and obviously, and this is it's different every time. This one being particularly unusual, but it's no longer, when things go down as they do, they're no longer stocks. They're just commodities. It doesn't matter what it is. They're pieces of paper. So everything goes down together, and also in some of these rallies, I don't want to say everything goes up together, but things when that happens, sometimes you do have to sell something to buy something, as they do, but or as many of these folks did. But you also the difference between quality. This is true in fixed income also. Some high quality fixed income sold off as much at various points as low quality did, and it wasn't. And it's just because, well, there's a lot of reasons in each case, but there's a lot of not just it's not just people coming in and getting upset and saying I can't take it anymore. There's a lot of money out there that is levered, and when the asset price comes down, it gets forced to sell. And there was a tremendous amount of forced selling in the market in March. And when you're forced to sell, sometimes what happens, and in fact, what we saw here is that sometimes the things that actually should outperform actually underperform because someone says, well, I'm going to sell what I can sell. I'll take a 5-point haircut on my AAA rated, bond that's maturing in 3 years because I can sell it. And I'll sell, and there may not be many people to buy it, but these other things that are going down in price, I can't even sell them. Or if I do have to sell them, there was, it got very close. I can tell you the market, and the Fed stepped in, and then policymakers stepped in. It got very, the market was not working. It's a big difference between sort of, markets falling and markets failing, and the markets were not working. There was way too much for sale than anyone could possibly absorb. The system was really coming apart. So anyhow, folks like this I thought had a very good opportunity. So with that, Jim, why don't we'll go back, and I would say go to page, I have it right here. Let's go to page, let's go to page number 14, please. Okay. This is a little bit looking back and looking forward, but I don't have as of today, we don't have any current recommendations. But we're working on a lot, and where it's a little bit of a 2008 playbook. I know that as of now, things are not as bad as they were, but in some areas they are as bad. And particularly within in the credit markets. And the credit markets are places is a place where you can go. And I think that we're probably lining up for a several year opportunity to earn equity-like returns in credit. And so, but I think I don't think this is one of these things where we're gonna, time the bottom on March 23rd. Or something like that. I think this is going to be something that we'll be able to revisit here, certainly I think in months to come. But what we're showing here is just to give you a sense of, you can see I would just use the yellow line, just gives you a sense as to the percentage of the marketplace in credit. And these are credit. When I use that term, that's a broad category of, it could be corporate bonds and corporate borrowers, all the way through into the mortgage market. Anything that's it would be fixed income, but fixed income of varying types of varying credit quality. And the reason why credit tends to be a good and interesting investment when it becomes distressed. You think, why would I want to invest in something where people are where companies are going bankrupt? Well, when there's a big difference between being broke and bankruptcy. In bankruptcy, when you may have seen some names already who are starting to file, Neiman Marcus, J. Crew. I think it's just the very beginning. What ends up happening is the bondholders are the company goes for sale, and they sell the assets, and the first people in line to get the proceeds are the bondholders, and the more senior you are, the higher up you are in the claims. And so as we get into a distress cycle, we're going to see more of that, and I think that you're going to see this yellow line shooting up. Not only is it shooting up, but the size of the market at this point is actually much bigger than it even was just in dollar values than in 2008. So this is where we're spending a lot of time thinking, because it tends to be kind of you invest with you can have a large margin of safety. It's not just hoping things go up, but you actually have a sense as to what you think, the assets are worth in a worst case scenario. On the next page, Jim, I may have sent this around to some of you all received emails. Was there a question? Sorry.
That's awfully busy, Russ. I saw it in your email.
Yeah, you got to get through those. This is I'm not going to go through this chart. I mean, everybody and their brother is, suddenly, an epidemiologist. I'm not going to pretend, but we have, a lot of that work getting done in house, and it was interesting sort of return, to work chart, and we kind of get these models. But look, I mean, at the end of the day, this is not the only crisis we're facing right now, but this is certainly, the big one. And we're I think a lot of our thinking is ultimately just from an economic standpoint is the return to work. And if there is such a thing, that's going to play or for that matter, if things get kicked further out, it's going to play a tremendous role on on what our economy ultimately looks like and what markets look like. The next page, Jim, I'm going to skip over. I mean, these are great pages. I'm going to skip over them, but I'll go into maybe page number 20, and I'll just use this as a to focus on the portfolio.
Their timeline of us going back to work dates out.
So you can see that. Sorry, I thought it was a question. That Mike, is there a question, Mike?
No, we're good.
Oh, okay. I just don't want to. Okay. You look at. You can see things have been obviously very challenging through the first through March. I think that April we don't have we're sort of back in the napkin because there's some numbers that haven't come in yet. But April is somewhere in up around 7%. So we've recovered a fair bit of what you see here. But clearly things. So I think if things are probably down about somewhere around half of what we see on the page here. But as you can see, it's really been across the board, and I would say that to some degree in a shorter term, it's if some of the portfolios have actually done worse than not only are that we would expect, but than they ever have in a difficult market scenario. And I can give you I'll give you some reasons why. I don't know that necessarily that means that these things don't end up turning around, but it's just very interesting that some of the investments that tend to protect more didn't protect in this last month, although we've seen some of that come back. If you turn into the next page, we can kind of just look through the managers, and we can kind of see where things are coming from. You can see where we are. Things are basically in line at the top of the page with our equity. Just the standard equity managers with Hamlin recently. Again, you can see they're a value manager, and they did what value did. And I don't want to. I can't really assess a couple months here, but that's basically in line with what I would expect. ClearBridge, who we just spoke with, was basically in line with growth, as it turned out, almost exactly in line with growth. But growth did better than value. They were, Amanda tells me, they were up over 14% last month. So they were, you can see, a lot of comeback in their portfolio. The guys who we look to, I would say, FPA, IVA, First Eagle, those portfolios are really the ones that I would refer to as they didn't go down. I mean, FPA, if you didn't go down as much as the stock market did, but it did go down, in year to date. It did go down as much in March, and IVA and First Eagle also didn't go down as much as the market. but it went down a lot more than it usually does in relation to the market. And I mean, I can dig into that a little bit, but I think to a large degree, it's not, and it turns out that it's not just them. There are a few others that we look at in that world, and it was almost, and it's to a manager. We didn't really find any of those types of managers. In fact, across the board, it was the worst single month in total for those managers going since October of 08, but it was the worst month ever in their history. Some that go back 30 years actually, relative to the stock market. They got much more of the downside. Two things to keep in mind there, and I'm focusing here because we spend a lot of time thinking about these guys too, so it's on my mind as well. But two things I think are important to keep in mind. One is that in reality, they did go down more than usual, but yeah, when we look at them, one of the things, there were two things, I'm just pulling something up to put my eyes on it. There were two things that we noticed. One is that the downturn, March wasn't the downturn. The downturn started in mid-February and ended on March the 23rd. And then March 23rd into the end of March was the beginning of an extraordinary rally. And the ACWI, I'm just using the MSCI ACWI index because it's global stocks, from the peak to the bottom was down 33 and 3% to be precise. And in that instance, each of the managers did go down. Crescent was, the FPA was down 29, First Eagle was down 26 and change, IBA was down 23.4. So they didn't get nearly the same downside as it might look in March, but what happened is they didn't get the upside coming back in those last few days. The other piece of this that I think is important is the growth versus value. The MSCI, the global stock market, was down 33, but if you just looked at the value portion, it was down about 37. And these guys all, and you don't have this visual unfortunately in front of you. I just actually completed it this afternoon, but what you would see is that these guys are all at this point of the game leaning more toward in value, and value plays a big role in what their performance is. Nevertheless, it's, and I'm just pointing it out. We would have anticipated that they would have done better. On the other hand, I would say, the mitigate, all of the other periods in the past took place over a longer period of time, and we're looking at something we've never seen before. So I'm not, I'm both disappointed, but I'm also realistic. So I think we're going to have to see how this plays out, over time. The other thing I've noticed in the past, again, is that they have gone down with markets in really bad markets and then started to recover while markets fell, a lot further. So, it's also possible that we'll see that. So we're kind of in the middle of the story here right now with them. But I think
Ross,
yeah.
Ross, this is Mike. I had noticed when you look at the chart on page 23 that both IBA and First Eagle took pretty large cash positions by the end of. So, do they take those positions? Is part of the reason I didn't recover as well in that last week and maybe into April? I mean, IBA is at 40% cash on March 31st, and First Eagle's at 20% cash. Is that partly why they missed it? Did they sell into the downturn, which means they didn't lose as much, but then they had too much cash when it recovered? I'm just
Yeah,
guessing.
they didn't. Yeah, it's a little bit of that, because so it's two things. One is that the real rally was in growth. Growth exploded upward. I mean, Amanda can tell you because she was the one doing them. We were doing, how we do quarterly performance reports. We were doing daily reports, and
It was a
and
blast.
yeah, it was a lot of fun. And so, we noticed that at the absolute depths of the month, you see the portfolio being down, 8, 9, 10, 10%, let's say, just rounding up here. in the middle of the month, the portfolio was down somewhere in 14 and change percent. March, call it March 15th roughly. And the market was down 30 some odd percent at that point. And then by the end of the month, the market had come rocketing back and got back, roughly half of its decline, but we only picked up about 2% on the upside. This is on the whole portfolio. And I really think it's for, and I noticed it was for a couple of reasons. One of the reasons was because the rocket back was mostly on the growth side. The other reason was, to your point, was about cash. But also, if I go back and I look at those past histories when they did well on the comeback, they had more time to put money to work. And I know they were, they're not going to like come in and guess which day. I mean, you're dealing in March, the market was moving 5-10% a day. In some cases, even more than that, in the middle of the day, not just beginning to end. So, they may have been interested in, and they were buying and moving the portfolio around, but they're not going to try and time which day it is. So they're going to buy a little, and then things just move completely away from it. So they didn't get the upside either, and so I think that held them back a bit.
Well, Ross, this is Paul. I would add there's some comfort that all three of them, FPA, IVA, and First Eagle, kind of behave similarly.
Yeah, I guess I'm yeah, it's frustrating and the times three and comforting by three. I mean, I can tell you that they're sticking to their guns.
Exactly.
They didn't see it. They also look. I don't know if anyone. I mean, I did, and so I hope none of you are as nuts as this, but watched all 5 hours of the Berkshire Hathaway meeting this weekend.
God bless you.
I think I missed
I'm
it. Sorry.
Tell us what happened.
Yeah, really.
Well, I will say this: there was a lot actually, and Buffett, he didn't look good, and it's interesting. He sold. You may have read he normally people think, oh, the market goes down, and that's when he jumps in. He sold they had airline stocks. He sold all of them at a fairly decent loss, and he didn't buy anything. And I think people look for him to buy. I think that's probably a bit of a misunderstanding as to how he actually operates. But one thing that this is not just him. We've seen this in other places. On March the 23rd, when the market bottomed, there were investments to do. There were things to do. And I mean, one example would be, I'll just use a headline example, and I don't have, I'm not saying this is Buffett, but there's some other managers we have exposure to who I do know were involved in this. Carnival Cruise Lines was at the table in need of money. Well, if you're in need of money, you go to, Blackstone or Elliott, who's a manager who's inside of Ironwood, for example, and you're lining up some financing at a fairly steep rate. Well, guess what? The government came in, and all of that stuff got basically bailed out. I mean, for lack of a better term. So he didn't get to put any money to work, either. And so there's I do think that what has taken place here with socialist type of an economy, and we're getting there, is or some Japanese style economy where we don't allow for the market won't take any medicine, and the government's just going to own everything. You can't solve the solvency problem, and so they may have just extended. They may have done what if you think about bending the curve, flattening the curve for COVID, where we're not going to have fewer cases. We're just trying to make it so that all the hospitals won't get overwhelmed. Maybe what they ultimately did, whether they intended or not, is they did the same thing here. We can't have the bankruptcy courts overwhelmed. We're going to try and spread it out over time. And actually, there was I haven't read any article. I've seen a few headlines about the bankruptcy courts don't have enough capacity to handle everything that's coming their way. Again, I'm talking about corporate bankruptcy. I'm not talking about, and that leads me to one other point I want to make, which is just for everybody to bear in mind. Here's the difference between '08 and where we are now. Not, again, I don't know what the future is, so maybe this changes. In '08, the excesses were in the banking system. Today, the banking system, under really what people consider to be actual worst case scenarios, is in pretty good shape. So the banking system isn't where it is this time, but there's a lot of where are the excesses? The excesses are in the corporate sector, corporate borrowing, companies, a lot of leverage in the system, as I said. It's the companies. It's not yes, the consumer matters a great deal, but it's the corporate side of the equation that is where the excesses are, and so that's where you're going to see more of the problems. Companies that can't, that borrowed and rates, were low, and people were willing to lend to companies at lower and lower rates. Well, guess what? At some point, if you can't pay, your debt holders, it's the companies that are going to run into the problem as much as anything. So that'll end up being. So I don't think it'll be an '08 type scenario where we're waiting for the next Lehman to go under, knock on wood. But I do think it's going to be much more in the in the corporate environment. And you heard ClearBridge say they're looking at which companies are going to make it out to the other side. And survival. It's a lot about survival. On the other end, if you do make it out on the other side, usually it means you don't have you're in a better position from a solvency perspective. But this is going to go on for this is going to this, I don't know if it's going to be the market volatility per se. I have no way to know that, and it's going to take events, but the cycle that we're in here, we're out of the late cycle. Now we're getting into the early cycle, and the early cycle is usually it feels the worst while you're in it, and it turns out to be.
Well, everything depends on the medicine right now. Everything just depends on getting the economy, people working and spending money, and mainly that's going to get better. And we're not going to have a vaccine next week or next month, but even some of the treatments, remdesivir or chloroquine or whatever it is, no matter how controversial they are. And the good part of that is we never in the history of the world, except for maybe the Manhattan Project, where we were trying to blow up the whole world, have put this many resources into trying to save the world. I mean, I'm not talking about stimulus. I'm talking about just all these labs around the world. I mean, those folks, I'm sure, are never going to bed. They're just in a lab all the time, working in collaboration. Now they have artificial intelligence to work with and supercomputers because of NVIDIA chips, and there's going to be a lot of really good stuff on a medical front that comes out.
Yeah, I think that I mean, there's and I'm gonna parrot a little bit of. So this is not. I don't want to pretend I'm the. This is my area of expertise, but obviously we're all spending a lot of time thinking about it. We don't have. We have history, right? I mean, you can look back at. We see history is good for behavior. You can see how people behave, like let's say in 1918, or some people think 1917, but it was the 1918 Spanish flu. You can see behavior, and you do have science. What I do know from the people who we know who are in this area is that is that a lot of the stuff, like even a lot of the stuff that they're looking at for the virus are things. There was a lot of work already done. Remember SARS just went away, but there was a lot of work done back in 2003, and there was actually there was actually what they thought was a vaccine, and then it went away. But technology in 2020 is a lot better than it was, and so there's a very big head start here. And I know that a lot of people talk about how long it takes to get a vaccine, but they didn't start from zero, for sure. But even if, reality is, even if warp speed, as they say, is 2 years as opposed to normally what takes 10 or 15 years to do, it's still there's it won't be tomorrow, but it's a huge thing. And also let's also keep in mind, and this might be we think about what the world's going to look like when the other end. There will be some new behaviors, for sure, and the other parts of the world. We talk about the U.S. Other parts of the world. There are other parts of the world that are handling, that seem to be ahead of us at this point. You think about emerging markets. Emerging markets they're used to crises, right? It's part of what they do. We're not used to this stuff. Our grandparents or something. So I don't think what happened in the first quarter or the last few weeks or even the last few years, even though it kind of keeps repeating itself, is what things are going to look like, going forward. And so I think from that perspective, I feel good about the value tilt in the portfolio, because typically value is what leads out, and you've seen that multiple times before. What else? I mean, obviously there's a lot in here, but I just want to make sure I at least got to the main things. Like I said, there's no recommendations as of today. I do think that and some of the things that that we're thinking and doing are things that are even that I can sort of go in and that are taking place within the portfolio. I do think that there will be somewhere in here, and if it's before we meet again, I'll let you know. But maybe by the time we meet again, there are just some things that I just don't want to time them. But we're just Amanda can tell you we've probably tripled our working hours.
That's true. I was gonna say it's like every day.
Yeah, because we're looking back and we're looking forward, and we're speaking with, and we talk to every manager, and we're looking at everything that we possibly can get our hands on. And it may end up being that we end up doing I think you really gotta really, we have under a variety of conditions, and do I how do I feel about it? Do I feel good about it, et cetera?
Ross, the only thing we didn't talk about, we sort of looked at our active portfolio.
Yeah.
We never have clear vision on what illiquids are doing, because then our performance numbers are almost never there. So what did happen in that world? Isn't that an area where perhaps they're going to buy some of these options, some of this distressed debt, and some of these other opportunities, if you will?
Yeah, we have some of that here. I don't think we have. I think we're a little bit more on what I would call the harvesting phase, where I think we're going to we could see some capital calls coming in. I think we're done actually with capital calls. Amanda, you may tell me that there's a little bit left with private advisors, but
yeah, they're for the most part we don't get a lot.
But there's also a period, and I think there's a period when I think Blackstone's even through it. There's a 2-year period when they can call capital. So I think we're going to see more coming back to us out of these portfolios going forward. And I think what we'll end up, trying, and this may well be where we fund some things from, but what we're looking at is most likely in the illiquid, or what I would call semi-illiquid space. What I mean by that is that the vehicles themselves are illiquid, that you can't get out of them, but what's in them may not be illiquid. It's just the way it just keeps them if you're a manager it keeps you from having to worry about, clients needing to take anything out of the portfolio, for a period of time.
Right, which just to reiterate for the group, does that make it easier, when you go through a crisis when a traditional fund manager is facing allocation? You said they have to sell something, they're selling, that AAA or AA credit just to get that side of the world.
Exactly. You don't want to be in a situation where you're competing with other investors in a portfolio, and that the manager has to look. The manager can sell something if they want to sell something, but you don't want to be in a position where you're managing liquidity. And I think that what we're learning, time and time again, each one we seems to go further and further along, is that you really, when you think of asset classes, you don't want to think about average liquidity or what it looked like normally. You want to think about in rough times, and you want to have a better match between your assets and liabilities. And I think there are a lot of mutual funds out there, high yield mutual funds, let's say, things that operate and are perfectly normal types of funds that you see in portfolios, but they do run into trouble. I mean, I can tell you that a lot of these guys, particularly in March and maybe even still, they're spending a lot of their time managing liquidity, because customers are taking money out of the fund, and it makes for a totally different equation if you have to sell something as opposed to being able to hold on to it, even if it's so you can sell it when you have an opportunity. But I think that'll put us in a good position as a buyer. Yeah, Paul.
I would imagine you have some ideas or preferences on how you're going to approach, or think you might approach, the distressed debt idea.
I'll tell you what we're looking at. We're looking at two areas right now. One is we're looking at the mortgage, what they call the asset-backed universe.
Right.
And these are, for example, AAA, AA rated mortgage securities. Okay, not kind of nothing. These are middle of the fairway type investments, but there is still a lot of dislocation there. Along those types of lines. Nothing super exciting, by the way. I'm talking about things that are normally, if the market were functioning, these were paying 3% per year type things, and they're discounted to the point where they may be paying closer, they may be down to around 10%, a year type returns, but what we would consider to be very safe 10% returns. Depending upon how things go, and things very well probably will worsen in credit creeping into these areas, that could become more opportunistic a little bit later. And so you do the safe stuff early. We were having, for example, when Bear Stearns fell, if you bought, you might have thought you had the greatest opportunity in the world, but you were kicking yourself by the time Lehman fell. But if you were buying credit when Lehman fell, you were kicking yourself again, because things didn't really bottom out for a few months later. So what I'm getting at is I think there could be several waves, and you don't need to be early in that. And the other area within distress is going to be probably some form of just of corporate distress turnaround. That could be, but it's going to be. I think it's going to be years, just years worth of stuff to do.
Thanks.
Absolutely.
Anyone else?
No.
Nope.
Okay, well, as the good book promises, this too shall pass.
Yeah. For
so,
sure.
I guess, for you looks like you have some things that perhaps we'll share in the August meeting. Are there any of the funds that you're looking at now that are on a watch list? I saw, I know it's a small position. Graham was in one of your notes, and is there any other managers in our portfolio that you've downgraded a little bit or are on some kind of watch list?
Yeah, I'll very briefly mention Graham. Graham is probably out of the whole portfolio, the one that disappointed us the most. Graham is a portfolio that we would normally expect to actually do well in a down market. In fact, you saw Abbey has been up during the market. Graham, and I'll spend just a, Graham is a macro strategy. Underneath Graham, there were, it's now pared back, but there were 17. It's one organization with 17 underlying strategies, not equally weighted. In the month of March, 15 of the underlying 17 strategies were positive. One of them was slightly negative. And one of their portfolios, one of the strategies is the entire reason for the decline in the month of March. So it's one more page forward, Jim, page 22. So you can see it was down 11.9% in March. It's just to give you a sense as to how upside down the world got in March. That portfolio is very heavily hedged. In fact, we thought of them as one of the best risk. The guy who sits in the center of it and runs it is one of the best risk managers. That we know in that space, who runs these types of funds. One strategy, which is a volatility arbitrage strategy, right? So you think, well, that's probably a pretty good strategy to have when volatility explodes. And it was for a little bit, except to make a long, I'm going to oversimplify here, but basically they would profit if volatility went up overseas in Asia and Japan, but they would lose money if volatility went up in the US. Now, of course, one's not going to shoot up and the other is going to do nothing, right? So it's just that you're looking at effectively make a profit between the difference between the two. So if you're wrong, you're usually only wrong by some very small increment. Well, volatility in the US all around the globe exploded, as you saw in the chart that I showed you, except in Japan, the Japanese central bank basically stepped into their market and calmed it down substantially, and their volatility fell a lot. And in a matter of several days, our volatility kept going up, and they were upside down on the position. And so they have managed out of that position, but at a fairly sizable loss, and much larger than they've ever had before. We have not recommended to investors to get out of the fund. We have downgraded it from sort of our highest level of conviction to to a more acceptable level. We're gonna see how they do going through here. But that granted, it's not a large position, but nevertheless, I would say out of every investment portfolio we have, we probably did the most hand wringing on that one because of a very, very small position in the portfolio. Again, like I said, I'm covering it at a very high level, but that's one that I think by August we're going to have a much better feel for.
Anyone else?
Yeah, good.
No, that's just, you can go.
No.
But I guess I'd add this other thing, and really what I didn't get into, but I'll just sort of say, is that on a relative return basis, when you kind of look at the portfolio versus benchmarks, It's not Graham going down less. They didn't go down as much as the market. The biggest area of underperformance, and this is something that I do think is something that it'll take time, in terms of recovery. But I do think it's something that we'll see. But it is in the fixed income area, and I kind of covered that page before to see how much worse it was, and it's underperformance versus the market indices. But in reality, the market indices probably painted a better picture than happened. And I think these numbers will even out over time. But by far the biggest area, sort of the attribution of underperformance, in this page, I mean, you can see, even MetWest, who has been remarkable they're at the absolute top of the peer group this year, could not keep up with the Barclays aggregate index. But you can see this M-star intermediate term bonds is the peer group. In other words, if you just look at the average manager, and there's a lot of managers in there, so just the average, 1.56 year to date, that I realize these are not big numbers. They were up 2.32, but that's an enormous amount of outperformance. But nobody, for the most part, could get anywhere near what the Barclays aggregate index did, and that was pretty much across the board. So, and you can kind of see it even on the next page. I do expect that unless interest rates go negative, which is possible. I mean, they keep saying that they're not, but if rates just keep going straight down, they go through zero and they go negative, and the trend just goes on, then I suppose that'll continue. But I think that there's a lot of technical issues taking place there that are causing that. But that's actually, you can kind of add it up. That's where all the underperformance is. When you sort of sum it all up, it's not the equity managers. I mean, look, even Pointer. I mean, I'll just use Pointer. That's an equity investment. It was down 7.7. It's down 9.93. Year to date. Yeah, it's great that they're a little bit ahead. They're down. They're a little bit ahead of peers, but you look at that compared to equities. It's a lot better than equities. Those guys did. Did what we would hope they would do for the reason we have them. But all the pain is in fixed income right now, and we've seen that before. That does happen. That is the classic example. If you ever hear people say, in a market crisis, all correlations go to 1. That's it right there. The assets that are supposed to diversify your portfolio begin to behave like the equities, for a variety of reasons, and one of them is because sometimes you have to look not at the asset itself, but who owns that asset, and a lot of people who own those assets were forced sellers, and it's going to take some time for some healing there. But I think
Ross, one last thing, I just want to clarify a question I asked before about IVA and First Eagle.
Yeah.
I did go back to December 31st, and they were both at the same cash position. So there wasn't a change. There might have been a change during the quarter, but there wasn't a change point to point. IVA was at 40 in cash December 31st. They were still in 40 in cash March 31st, and First Eagle was at 20 in cash December 31st. So I partially misinterpreted because I hadn't gone back to December. So just to clarify that.
There was. I mean, I think net. I think IVA ultimately put about 1% worth of their portfolio. I know they were more active than that, but I think ultimately ended up with about 1% more of the portfolio invested, during the time frame. So yeah, they did not have. Were mostly concerned. They wanted to make sure that the companies that they own had, fortress balance sheets that could survive, a situation where markets were closed and, their company's operations were shut down. But look, keep in mind one thing to keep in mind through all this, and this is what the long-term speech is, that when you think about how much a stock is worth, and how you value just a stock. It's earnings that go out way, way, way into the future. And if the entire stock market, just aggregate the S&P 500, if earnings went to zero next year, literally all companies stop making any money. I'm obviously speaking hypothetically, of course. And then came back half the next year, and then got sort of back to where they were several years later. Obviously that would be a terrible thing, and everybody would be going crazy. But what would the actual intrinsic value? What would that do to the intrinsic value of a stock? Just on an old style discounted cash flow type of a model, it takes about 5% of the intrinsic value off the stock market itself. And actually, the page I guess I'd end on, Jim, is I would go back to the last page of the charts. This one right here, this clairvoyant, the clairvoyant value. This line, this red line that becomes green, the sort of smooth line, this is what the stock market is worth over time. If you knew earnings looking back, if you knew the future and you can go back and figure out what the S&P 500 earnings were, and then say, okay, I'm going to value that using 50 years worth of dividends. And remarkably, the stock market, the average return of stocks and the intrinsic value, it's the same thing, except you can see that crazy squiggly line is what stocks actually do. So stocks, I've talked about this in many ways before, but I think this is a great way of looking at it, is that stocks are either overvalued or undervalued, but you never get the average value over time.
That's a great chart. Wow.
Yeah, it's an old study. The original one was done by Robert Shiller, who also does the CAPE ratio. It was a paper he wrote back in sometime in the 80s. And that's why there's a couple lines in here, because his numbers end around the red line, and then the investment firm GMO just picked it up, and you can see them extending, they just add to the numbers with the green line going forward. And basically, the stock market is a very smooth, is a very smooth thing for the market, but the actual market itself is 17 times more volatile than the volatility of the actual value, of the market. So all this stuff that we spend all this time looking at these charts, probably is more entertainment than it is informational value. We're always trying to figure out what are things going to do, but ultimately it comes back to value, and that's why we spend so much. That's why these value managers, and I know it frustrates me, and it can frustrate a lot of people, and a lot of people have been giving up on value. But that's what value managers are trying to do. They're just trying to figure out how much something's worth and decide what they're going to pay for it. They're not trying to figure out what the market's going to do.
Interesting.
Very interesting.
Yeah.
All right, we'll leave on that high note. I guess the only thing we have to finish with tonight, and we can all go back to our other, we could say home, is election of officers, just the information, pension disbursements, and the summary of bills we just include. So is the election of officers today? Do we talk about it for the next time? That's the question for Jim.
So maybe I'll just start with a refresher that we elected the officers last year. I think by our bylaws, it's something that we have to do once a year. Mike, you obviously have been the president for a while. Dennis most recently was the vice president, and Mark Izzo has been the secretary this past year. So I know we're missing, I think, a given meeting.
We have a quorum? Is there a quorum?
We do have a quorum.
Well, why don't we go ahead?
I think it'd be a good idea.
I nominate Michael as the chairman. Michael Evans is chairman. Did you hear me?
Yes, and I would accept that.
And I'll second that.
So do
That
we
was-
vote?
That was, Dennis Flagg made a motion. I think it was Mark,
Yes, Mark seconded.
seconded.
Okay.
So, all those in favor?
Aye.
Aye.
Uh,
Well, then I will make the motion to have Dennis continue as the chairman of vice for this group. Would you accept your continuing role in that, Dennis?
Yes, I would. Yes.
Okay, can we have a second?
I'll second that.
All those in favor?
Aye.
Aye. And for the final one, Mark, if you're willing to still be our esteemed secretary of this group, I will renominate you to continue as the third officer of this fine contingent.
Humbly accept the honor.
Okay, and can I have a second?
Second.
And all those in favor?
Aye.
All right, well, Dennis, thank you. We're all set.
That's what happens when you all do such a good job.
Do we think that we're going to still be social? Thank you. Do we still think we're going to be socially separated or whatever term we're using come August?
Hell no. I
Good
can't
for
take,
you.
I can't take any more. I've had it. Had it.
I
Well-
just need to give Ross a big hug somewhere, you know?
Well,
Yeah.
the most important thing, and Mark would care about this maybe as much this year, I would say almost as much, but this year as I do, is that I'm good friends with someone who's involved with my oldest son's baseball team, and he's one of the senior folks over at NIH, and works closely with with Fauci and so on, and our number one concern is when we're going to, if we're going to even have any sort of a baseball season. And he says that he does think that he thinks will be, what we'll be able to do. He said that those, kids aren't going to go to summer camp and, and sleep, those kinds of things, but outdoor activities. And there was a newspaper article. I was able to find it online where there's a picture from 1918 and there's an umpire wearing a mask and the catcher's wearing a mask and the batter's wearing a mask. And he said he doesn't even think we'll have to do that. But so Mark, maybe you'll have a real grand opening this summer.
All right. Well,
that's great.
here's the sad part. We built that beautiful field, right?
Yeah.
Those senior kids never stepped on that field to play a game. They'll graduate and they'll never play in that $21 million field. It's a freaking shame.
Yeah.
So sad. I feel so bad for those kids. I really do.
So
Well,
Mark,
well,
it was this season was going to be the first season playing in that field?
Yeah, baseball, and softball. So the girls and the boys, both kids, everything was ready to go. Place looks great, and it's just been locked up. Yeah.
I know,
Yeah.
there's so many of those stories everywhere,
Sick. Makes me
so many
sick.
stories
Yeah.
for the children.
Yeah. Oh,
Well,
wait to see what next year looks like.
all the tournaments that didn't happen, all the high school tournaments, all the college tournaments,
All the graduations.
all the graduations.
Graduation.
weddings. I mean, and we've had a few clients, I mean, you can't even do a proper wake and funeral right now, which is so sad.
Just terrible. Oh, well. Like you
Hopefully that'll be
said,
different by the time we all reconvene.
yeah, let's hope so, huh?
Let's hope so.
Okay.
All right, well,
Everybody play safe. Play safe and be healthy.
Something, can we approve the invoices and, just, make note that in the agenda, there was a summary of the recent.
Yeah, so, as I said, those are in the agenda,
Yep.
so, it's just for your information, okay? All right,
Very
good
good.
night, everyone, be safe,
Good night.
Super, thank you, everyone.
Thanks, guys.
enjoy. All right, take care.